Let me go across now to Alex on the editor's cut with the attempt to put all of these stories into a bit more perspective, Alex.
Absolutely. Thanks so much, Samina, for that. We'll start with the regulatory action on JM Financial, because this probably has implications for the wider space as well. I do want to read, and Vishy is going to break that down for you. Samina is going to talk about the small and medium REITs, the implications of that for you as an investor and also for the space as a whole. But on the JM story, I'm reading the statement that they sent out last week after the RBI action. They said, after a careful and detailed review of the order issued by the RBI, we strongly believe that there have been no material deficiencies in our loan sanctioning process. That was on the loan side. There was practically no response to the SEBI action. There was joint action by the SEBI and the RBI. Now we know why, but what is the latest action now?
Yeah, so just about the statement now, right after the SEBI action, the only statement that came from JM Financial was that they are unable to ascertain the financial impact of this action, and that they will cooperate with SEBI. They didn't sound so cooperative with the RBI. But just to put things in perspective, what SEBI essentially looked at was one NCD issuance. Now, of course, they're saying that they're looking at other stuff, but at this point in time, the debenture issue is what led to the action that SEBI is taken against JM Financial. There they found that JM Financial Products was acting as a lender to investors. They were getting retail investors who come in and buy into these debentures, and then on the listing day, they were selling the securities that were bought by these retail investors to institutional investors, which is essentially JM Financial Services. So they acted as the lender, the operator, and the borrower. So, and that became, according to SEBI, that was a shocking sort of set of events. And the way that this was done, with the timing that it was done in, looked like it was planned well in advance. The problem happened because they promised certain returns to these investors. The securities were actually sold for a loss. It's unsure which debt issuance they were talking about, but sources
2023.
Sources say it's Pyramid Enterprises, because that's where the timing matches. But we're not getting into that part of the story. This action follows just a day before that. The Reserve Bank of India said JM Financial Products has been, showing some lapses in the way that they were doing the debenture financing as well as IPO financing business, and therefore they've barred from lending against securities.
But two questions on this. One, you've laid out what they did. We've also spoken about what the SEBI has said. What does this mean for JM Financial, one? And the second part is the wider space. One would assume that if one entity is doing this and they've said on the RBI action that this is industry practice. So what does it mean for the industry?
For JM Financial, as far as they're concerned, lending against securities and their debenture financing, debenture lead manager business, all of that goes away, right? And that's a problem for the entity, because they were a large player in the NCD market. Now they can't do that business going ahead, at least for the foreseeable future, because SEBI investigation is likely to take another 6 months, and then after that there will be, of course, some amount of back and forth between the two entities. We'll see what happens. For the industry, there's a problem, because the RBI has already sounded alarm bells about dependency of NBFCs on the bank financing route. So NBFCs were anyway shifting that fundraising to the NCD market. Now, if there are questions raised about the NCD market, then where exactly do these NBFCs go and raise money? Because they need those funds to actually go out and lend. And if there is some amount of ripple effect on these entities, that's going to be a problem, because if the NBFC industry can't grow, then you can't support that bank financing in tandem.
Okay, interesting. So fallouts beyond just the issuance. And also, by the way, Sajith was talking about implications for SME IPOs and the possibility of oversight, regulatory oversight. The SEBI chairperson, of course, has gone on record to say that the IPO market has seen froth, and perhaps you could see some action there as well. All right, so a lot to unpack, of course, and we'll get more details over the course of the day. But let's turn attention to another interesting piece as well, which has to do with the real estate space. And interestingly, Samina, small and medium real estate investment trusts. I guess to a certain extent they want to get into the residential space or make that more lucrative. What are the key highlights here?
Yeah, Alex, I think the whole weekend was buzzing with what SEBI has done. They are ahead of the curve, interestingly. But let's just break this down for people who are confused whether this is good news for the real estate stocks. Is it great news for an investor? Let's start by telling you what a REIT is, right? A REIT, for a very simple reason, is like a jar where investors pool their money in, and that money is used to buy an asset. Currently in India, you've got 4 listed REITs, the likes of an Embassy, a Brookfield, which were allowed up until Thursday to only invest in commercial real estate or malls. What the SEBI has done is they've come out and said that now smaller REITs, so the REITs, the traditional REITs have, of course, like the embassies of the world, are fairly large, has come out and notified that small, medium REITs will now be allowed. They will be allowed to have smaller sort of quantums of investment or smaller jars of money. And more importantly, I think what got the street excited is that you can now invest or have fractional investment in residential real estate, which means that the SME REIT can go out and actually buy an apartment, buy a floor, buy a second home, a villa. The minimum size of REIT has got to be 50 crores, going all the way up to 500 crores. The investors got to have skin in the game, because what they're really trying to do is protect investors, right, of 5%. Now, if you take a step back, are we saying that retail investors have never invested in fractional investment through real estate? Of course they have. Yeah. It's just been in a relatively unregulated market, right? By doing this, the regulators ensuring that there is some amount of protection that's brought in for fractional investment in residential real estate. But of course, when we say retail investors, I don't know how retail it's going to be. It's 10 lakh rupees is the minimum ticket size. So you're still looking at a segment that is considered more ultra HNI in that regard. So while this is great, gets a thumbs up, a lot of real estate companies like the likes of a Godrej Consumer are sitting on unsold inventory in places like the Godrej Properties in Thana and New Bombay would probably go out and look at the REIT
even the smaller developers.
Structure. Yeah, so that comes in from a real estate sector play, right, where these counters will do well. But for an investor, now let's take a step back. India is a low rental residential yield market. Currently, rental yields in India are in the range of 2 to 3%. At best, you're looking at a 4%. How do you earn on a REIT? You get your rental yields and you get capital appreciation. Let's not forget that while rental yields are the 2 to 3%, where that's one function of returns coming in for investors, the other one is capital appreciation. We've all seen, right? Real estate has seen an appreciation now after many, many years of underperformance. If I have to peg a number to it, an annualized return, it's no more than 5 to 6%. Correct. Secondly, the bigger chunk of capital appreciation...
In certain markets, I must point out. In markets like Mumbai.
You mean best case scenario?
The larger markets,
yeah. But what also is worth noting is when the appreciation comes in, it comes in from buying the land, building it, and then selling it. So the appreciation is from buying the land, right? What the REIT and SME has said is the regulators said you can only invest in properties that are 95% completed, which means they're already yielding rent and the appreciation has been taken. Beyond that, how does capital appreciation happen? It's going to impact the NAV only if you're going to go out and evaluate the real estate in some cases, or in other cases, sell the real estate. So you're not really going to see the chunk of capital appreciation coming in for a very long time. The other thing that I heard from one of the analysts yesterday was they said that while this is great, cost of compliance is also going to go up. So that,
why is that?
Too, because now you're going to have to review your assets. You've got to do a lot more paperwork. You've got to get a lot more auditors in. While it was unregulated, it was easier because while there was a risk involved, the returns were slightly higher, right? But with being regulated, cost of compliance goes up. Getting a REIT to listing is also going to take some money.
So, quick question on this in terms of operations. This has come through. Would you have the same entity float multiple REITs because of the ceiling size of 500 crore, or is it each REIT will be only 500 crore?
Each REIT can go up to 500 crore, so that's one unit, right? I think the challenge is more on the downside, because how many homes can you, I mean, think about it operationally. How often do you come across an apartment or a floor that's 50 crores? It's not very often. So the REIT might have to buy maybe an apartment in Bandra or in Bombay, a holiday villa in Goa, one in Bangalore. But all of that is very difficult to manage, operate, and run. The other thing that I noticed was while all of this provides, and I mean, the fact that you have REITs that are listed, it's liquidity, which makes things easier. But because it's so early on, if you as an investor go in and invest in a REIT, and assuming you want liquidity in a few months, will these REITs be able to provide that liquidity, right? So because early on, things are going to be tough. So net, step in the right direction. As an investor, returns not very exciting unless the India landscape changes and rental yields go up to 5-6%. Commercial REITs are still far more attractive because you're looking at a 9 to 10% yield in that market. So good news, I guess, more for real estate companies as opposed to investors.
I guess, but to the point on fractional ownership, and this is the last point I will make, maybe you can counter that, is that for so long we've talked about real estate as a part of your investment portfolio and how, because of the chunky size of the assets, you can't really count your residential, your home, you can't count it as part of your assets. But if you have a 1 CR portfolio and you're saying, okay, 10% allocation towards real estate, it's possible.
Indeed, it is possible, but I'd still pick a commercial REIT over a residential REIT at 9% and capital appreciation. And more importantly, while Alex indicated 1 crore, let's not forget 1 crore in India is categorized as an HNI.
Absolutely.
So if this is for retail investors looking at getting a piece of the pie, you might want to take a step back. That's not really what's going to happen. But like we said, the industry is giving this a thumbs up.
That's a very fair point. All right, let us know what you think. Would you consider fractional ownership? Do you think that it's affordable? Do you think that the value of 10 lakhs should be brought down? All of that on our social media platforms in the comment section.